welcome to the August edition of our Beyond Wealth Advisors Economic Update. I'm John Cleaver, partner and senior financial advisor at Beyond Wealth, and back with us today is Kelly Manning. Welcome, Kelly.
Thank you. Glad to be here.
Absolutely. So, there's just a little bit going on these days, and so the topic for today is how do we keep perspective in the eyes of all the volatility that's going on. We've had just a little bit of that recently. Yes. And so I think the questions we're hearing more often is, should we be concerned about the economy? And is recession on the horizon? Certainly the word recession and talking about recession isn't something new. We've been pinging on this over the last 12 to 18 months quite a bit. But it seems to have reared its head more recently just in light of the volatility.
Yes, so, correct. But before we really answer those questions, we need to take a look back. See, how did we get to today? The month of July was a strong month for both fixed income and equities.
Yeah, absolutely. And really the whole first half of the year, right? We've been on a pretty good trajectory. I think some of the things we saw in the month of July really emphasize this. Number one, we saw really high quality bonds post their best monthly performance since December of 2023. And right along with that, even high yield bonds and international or emerging market bonds were also up almost 2% month over month. So we're seeing that strength on the fixed income side. I think maybe that makes sense in light of where interest rates are and where they could be by the end of the year. But that's also leading to some growth in global equities. I think 8 out of the last 9 months, we've seen a rally in global equities. Not completely surprising. We've seen some international countries lower their interest rates. Earnings season has been good internationally, so that makes sense as well. Large cap, another amazing month. If we look back at July, we continue to hit record highs. I think we've lost track of how many record highs we had hit up until the end of July. Historically, the month of July is good. It proved that again this year. In fact, 10 straight years, the month of July has had positive returns, which is kind of a crazy stat.
It is.
And then when we think about the different sectors that we invest in, 9 of the 11 sectors were positive. That's really, really good because we're seeing a broadening. We're seeing the strength of the market spread out, not being just quite so focused in one particular area. And then probably something we've been waiting for, anticipating, was for the first time small caps. The smallest companies out there had their widest margin of growth over large caps since the year 2000. So it's about time, right? And we saw the Russell 2000, which really tracks small companies, month over month was up 10%. Really speaks to why we talk about being diversified, because even though small caps have lagged maybe longer than we wanted, you don't want to completely eliminate them because at some point it does cycle back. So all of that great news got us to the end of July. And then we flipped the calendar over to the month of August, and it was a much different story, of course. So equity markets really changed their tune quite dramatically. So, Kelly, what's kind of behind all this volatility?
Well, John, there's quite a bit behind the volatility. And, some of them are kind of small. But summer volatility is not unusual.
Right.
When major economic data releases that challenges the market narrative, we're going to see some volatility.
Right.
And then valuations, we talked about valuations at the early part of the year. There was a lot of good news that was mixed into or priced into the market.
Right.
And so when economic data or earnings or disappointment, we're going to see volatility.
Right.
But another thing that I think is really interesting is investors have become overly optimistic and maybe even a little complacent.
Almost expecting this ride just to continue.
Yes. Yeah. Everybody's a little bit greedy when the market's doing well, right?
Sure.
But what's really interesting is when you have a bullish investor, the percentage of those bullish investors, when it rises above 50%, historically, that leads to a negative short-term
Right.
return. So we just kind of need to be on guard
Yeah.
as investors.
Almost take a breath and realize that
Take a
some of
breath.
this isn't all that surprising.
Correct.
Maybe even should have been expected at some point.
Yes, well, and that leads to my next point
Yeah.
on volatility is there is historical precedent. You know, when we look back, the market typically has a 3 to 4, 5% pull downs every year. We also have a 10% pullback every year.
Right.
So this year to date, we had only had a 5% pullback.
And that was the month of April, right?
In April. So we can expect a little volatility. We can expect a little bit of pull down every single year. But, you know, we talked about the beautiful thing about July.
Right.
Julys have been great, but unfortunately, August and September historically have not.
Right.
So we just kind of have to watch, you know, and see what's going to happen and expect that volatility. Probably the biggest thing that we have to talk about with volatility, though, is the election.
The election, really. There's an election this year, right?
There's an election this year,
right.
And it keeps changing.
It does keep changing.
So when you have an open U.S. election, that is going to create market uncertainty.
Right.
Market uncertainty leads to volatility.
Right.
And when you take an open election, the 100 days leading up to the election, we are going to see volatility. So we are currently in that situation. Yeah. So all of those things are kind of creating this volatility that we're seeing.
And that really speaks to, we often talk about the difference between the market and the economy. So a lot of that volatility is driven maybe, or it shows itself in the market, but the economy itself, you know, may have stronger underpinnings that give us some hope for the future.
Absolutely. And there is hope for the future. But that goes back to our original question, right?
Yeah.
So should we be concerned about the economy? And is there a recession on the horizon?
Right. So I think the one thing when we think about a recession that we've been hearing over and over again is until the labor market really tightens and unemployment increases, it's quote unquote impossible to have a recession. So we have seen the labor market deteriorate. In fact, we've seen unemployment rates come up. And we've also seen consumer spending slow down. Now, this isn't a surprise. The Federal Reserve is intentionally trying to slow the economy. They're trying to create an environment where inflation comes down. The result of that is going to be increased unemployment potentially, and consumers are going to spend less money. So we're not necessarily caught off guard on that, but at the same time, the job market, while weakening, is still relatively strong.
It is.
And there's some good reasons why we have some rising unemployment. We've certainly seen more workers enter the labor force. That's an immigration issue at times. And there haven't been as many layoffs. So, people are having a harder time finding that job that they love and staying in that job they love. I think at the same time, corporate spending remains strong. Certainly we saw kind of that AI push earlier this year. That's still sorting itself out.
But it's still continuing.
It is continuing.
Although it's sorting itself out, it continues to do well.
Absolutely. And certainly government spending, there's a lot of planned government spending that's even yet to happen. And then, just a constant reminder is we still have record amounts of liquid cash on the sidelines. And, even as we've seen just even recently in the last week, when we do get a potential pullback or the market softens, we often see that cash come back in, and that helps create, kind of that new floor. So, can't always count on that cash to come in and save the day, but it does offer an opportunity for a bit of a rally.
But it's also there.
It's there, and it's not going away.
Right.
And most people that are looking for opportunities, when they see them, are going to jump onto that. So that brings us to our last topic, and that is interest rates. So that's kind of been the topic of the year, right? How many interest rates? When are they going to cut? They didn't cut. They're going to cut. And so I think we're nearing that opportunity now where most people feel like the next cycle, maybe September, is likely already have a cut planned.
Yes.
And it's probably already baked into the market a little bit. So, what impact will that have? Again, market versus economy. I think a lot of people are expecting that. Yes. Maybe even another cut or two by the end of the year. So
I think it's probably reasonable that we have 3 cuts by the end of the year.
Yeah. The question is, we have to expect the Fed to act appropriately. They haven't always been known to do that, and sometimes they're a little bit late to the game. We see that pendulum swing just a little bit too far the other way. And, over the last few months, we've been talking about this soft landing concept. They're trying to hit it perfectly. The question is that actually going to happen? Correct. I think the good news is that even if they do miss it slightly, there's opportunity for the economy to recover relatively quickly. Lowering rates, cash on the sideline, spending, all the things that we've been talking about.
Well, I do think that, the Fed does have that possibility of pushing us into a recession.
Right.
But I think it is important to note that at least at this point, we don't see an imminent recession.
Right. Yeah.
That, there are potentials, but we don't see it as an imminent threat.
Well, and then let's take some solace too in the idea that on the flip side is fixed income, which wasn't really something we talked a lot about, really continues to provide 2 things. 1, capital preservation, and number 2, income. Clients are getting rewarded for really being more conservative, taking on some of that capital preservation, whether it be through money market or a bond strategy or just fixed income in general. And that's something that we didn't have for a period of time. So there certainly are ways that you can still benefit from what's going on, even in spite of and keeping perspective of all the volatility.
Correct.
All right. So with that, what's our message? What's the takeaway?
The takeaway and the outlook that we have is, we can see that the weakness may continue, but that's okay.
Yeah.
We're okay with that.
Right.
And we kind of expect it. But the nice thing is the downward pressure kind of creates that buying opportunity.
Right.
So all of a sudden equities are on sale and, we all like a good sale. So we talked about all of this cash and money market that's on the sidelines. We now have the ability to possibly buy those equities on sale and maybe create a little bit of a rally in the next 100 days.
Absolutely. All right. So during these times of volatility, don't panic, stay focused, revisit your goals. I think one of the things I love to do is just pay attention to your goals. What was your investment objective to begin with? If your investment objective hasn't changed, then maybe your investment strategy shouldn't change either. And then, of course, as always, it's just such a great opportunity to sit down and just have that conversation. What does it look like uniquely to your situation, and get with your advisor and see where you're at. So, all right. Well, I think that about wraps it up.
We're ending the summer, going into school. So all of you who are sending kids back to school, enjoy.
Yes.
For those of us that are sending kids off to college, it's a transition. It's the end of a season, and we wish you the best of luck.
Absolutely.